If you're interested in checking out TradeNet, they currently have a sale on their base package, the intro package, where you can get it for 30% off at $350. And that package comes with a funded account with $14K in buying power with a $700 max loss. But there's no PDT rule, and so new traders specifically can day trade as much as they want without necessarily risking what they would if they deposited thousands into a regular broker. And so for new traders, I think it makes a ton of sense. And if you're interested in checking that out, I'll include a link as well in the description. And so thanks for watching and enjoy this video. Okay, so tonight's class is on finding consistency in trading. Like I said, it's one of those things that, it's really hard to grasp and understand what it takes to be consistent as a trader and to really understand that consistency. And so tonight we're going over the process. It's not a huge class. The PowerPoint's a little small, and we may end a little bit early. It all depends on when we finish it. But it's ultimately about finding consistency in your trading. I know that's a lot of people's goal. That should be everybody's goal, is to be consistent as a trader. And tonight we're just going to be going over that process in general and just kind of the steps I've taken to show consistency in my trading as well. And so to get started, there's consistency and no consistency in trading. Typically, no consistency revolves around trading in a broad manner, thus not taking enough data from each strategy to really target down what works. This is one of the biggest mistakes new traders make. I think we mentioned it a few times, but they trade too broad. They're a participant of everything but a master of none. And you really, as a new trader, you really just want to focus on one thing and really master that first before moving on to something else. A lot of times traders will kind of watch other traders and, they try to emulate all these different traders that they're watching, and the results are usually pretty poor because they're not really focusing on one thing. They're making it too broad. They're not actually trying to master anything. They're just trying to kind of understand how to do everything, and that's never going to work. You have to focus on getting really good at one style of trading before you can move on to that other style. And if you can't do that, then you're bound to fail. Okay, so the way to combat that is to really target down and master one strategy first. Like this says, if you can master one strategy and you can see that strategy in your sleep, you can read out where you're supposed to enter, exit, take profits, so forth and so on with that one strategy without having to read it. If you can memorize that, then you're on the way to being successful as long as it's a viable strategy. Okay, and so focus on one thing, take it slow, focus on one thing first, and then you can move on to trying other things. But you want to be really good at one thing first. And that's the point I'm trying to get across with this one. Another thing that people that don't really have any consistency do is they use the same share size for stocks that have different ranges, prices, etc. And thus, they do not have consistent wins and losses. I'm a victim of this sometimes myself, which is like, I'll trade a stock with 100 shares that's $2 and then trade a stock that's with 100 shares that's $20 that has a much larger range. And the result is that I'll be consistent, but when I take a loss with that bigger range stock, that loss is going to overpower any wins I've had. And so if you want to find consistency, true consistency as a trader, you need to stop doing that. And the way to combat it is to analyze the price and range of each stock before trading it, and using that stock's price and range more specifically to determine that appropriate share size. Just because a stock is more expensive does not mean it has a bigger range. And just because a stock is less expensive does not mean it has a smaller range. Okay, and that's the one thing you want to look at. And we're going to go over how to analyze the range of a stock a little bit further in this PowerPoint. But you want to understand that about trading, right? You don't want to just use the same share size for everything because, again, you're going to get the same problem. You're not going to have consistent wins and losses. Your wins might be decent. You might have a decent accuracy rate even. But if your one loss comes from a stock that has a monster range, $2, $3, and you have to set a much larger risk for it, again, your loss is going to overpower that winner or those winners that you have. Think about it like this. There are 3 winning trades in a row, and then you have 1 losing trade. But that one losing trade, the range was huge on the stock. And so you're going to lose way more than that, and you could potentially just cancel out those those 3 wins with 1 loss. And so you want to understand the different ranges of stocks and calculate that before you get into the trade. And again, this is a super common mistake a lot of traders do. They try to use the same size with everything. I'm guilty of it myself. But something I've been doing lately is that I don't mind taking 200-300 shares if the stock has a smaller range. And I don't mind taking 50 shares if the stock has a bigger range, because my goal is to be consistent. I don't want to have 3 winning trades, but 1 loss just completely knocks that out because it has such a huge range. I'm trying to really keep everything in a consistent manner, whether it be my wins and losses, whether it be my stocks that I trade, all of it. I want to keep everything as consistent as possible. And that's one thing you want to do, is that you want to analyze the range of the stock before jumping in. And if it has a larger range, you can in turn scale down. Another thing here, they don't analyze data from their trades and strategies, and they trade what quote unquote looks good. Excuse me. And this is just the wrong way to trade it. The way to combat that is you backtest and review your strategies and trades often as you can, because that's how you're really going to know if a strategy is good, not just whether it looks good. And so the whole goal is to really target down on your consistency. Work towards that consistency. Try to keep everything in an even manner, except for share size and ranges. But understand that. And if it's hard for you to calculate a stock's range, then try to just stick with stocks that have a similar range to each other. That's a way to approach it as well. But you want to backtest your strategies, you want to analyze your trades, and that's ultimately how you're going to target down on what actually works. And then the last thing here is not having or ignoring your trading rules. Even if you have a great strategy mapped out, even if you have a great plan mapped out, there's certain things about each of us in trading that can really kill our trading profits. There's certain small little nuances about us as people that can really hurt our trading. It has to do with each of our personalities. And by giving yourself rules, you can kind of curb those little errors that you make. And that's the goal. And if you don't have rules, you're going to let that personality, those bad things about you and about all of us, destroy your trading. And so again, the way to combat that is setting very, very targeted, specific, personal rules for yourself based off past experiences. And we'll go over how to identify those rules a little bit later. But I just wanted to show you guys the difference between what's a consistent trader and what's not. Most consistent traders do these 4 things, and it really helps their trading. And it's really going to be the way that you start to see some consistency in your trading. And now we're going to really target these down here. All right, so the first thing I want to say is touching on trading with a broad brush and why it hurts new traders. So, if you really boil this down, when you first start to trade, a lot of times you're overwhelmed with different strategies, setups. You don't know what to do. And a lot of times, like I mentioned earlier, you're going to watch other traders, whether it be on YouTube or Twitter, and try to keep up with what they're doing that way. And that's fine. I understand that. I do it too. But the problem comes when you follow multiple people, multiple others' strategies, and you try to trade all these different strategies that you're just kind of sponging up. And again, like I said earlier, this makes it so that you are not specializing in anything, and you're just trading everything under the sun. And that's what you want to understand as a trader, is that you want to be really good at one thing first. Focus on one thing. If your thing is bear flags, focus on bear flags, or just flag patterns in general. If your thing's the VWAP fade, focus on that. Or the VWAP plays, focus on VWAP plays. If your things are moving averages, focus on them. If you like opening range breakouts, focus on those. But really focus on those. Don't focus on them, but if you see another trade that you really haven't ever taken before, you're just going to try it with real money. That's not what you want to do. Focus on one thing first and really targeting it down and mastering that one thing. All right, so let's go through the step-by-step process and how you're going to do this. And so obviously there's a lot of good information online about different day trading strategies, and people have had success with them. And so that's fine. You can research those strategies, if you want to, and that's good. Research as many strategies as possible. Now, I'm not going to tell you what strategy to pick, but once you have a few strategies picked out, maybe get a list of 5 different strategies that you understand, that make sense to you, and just paper trade with the sole purpose of finding that one strategy that you think has the most potential. Again, you don't want to, at first, when you're trading, specifically when you're paper trading, you do not want to focus on emulating a real money account. You don't want to treat it like it's a real money account. You can later on. But when you first get started, you want to just collect data for the strategies you try. And that's what paper trading is really good for. You do this for a few days, a week, however long you like, and you try to identify what gave you the most positive results. What worked? What did you enjoy trading? What did you think had the most potential? That's what you focus on. Once you have a potential strategy picked out, you can practice risk-reward management on that strategy and learn how to put a plan in action. I think this is pretty important in trading. You just want to learn where you're going to usually set your risk for that strategy, where you're going to usually take profits for that strategy. Put a plan in action. Understand how to implement that plan with that one specific strategy that you choose, regardless of what it is. You guys know me with the VWAP fade. I like making my risk somewhere based off of pre-market levels, or maybe a previous high or low in that stock's movement on that day. And then I like to take reward at the previous low of the day. That's typically how I approach it. And like this says, you want to develop, if you go back to our backtesting class, where you would consider that trade or strategy a success and where you would consider it a failure. You want to mark it down. Where is this successful and where does this fail? And then remember, be objective about the viability of your setups. You got to be honest with yourself. Even if you get super excited about it, you got to be honest with yourself about whether it actually works. Super important. And so then I think everybody's probably watched our backtesting class. But then you can go back to backtesting that one strategy. Once you have that strategy picked out or set up, as well as targeted that specific success and failure rate, success and failure levels, you backtest it with historical data. And, let me know. I can send you the 2 backtesting classes we have. I think they're good classes, and I think that you can, really understand how to test strategies. But like my previous November backtesting showed us, this should identify 1, the favorable conditions for that specific strategy, 2, the favorable sectors, 3, the favorable stocks, and then a lot more decent information that you can use to guide you on that strategy. Another thing I didn't really include here is that it should identify whether that strategy actually works. I think I can't really stress that enough. You got to make sure the strategy actually works. If you backtest that strategy and it's got a 20% accuracy rate or a 30% accuracy rate, and it doesn't really give you good risk and reward, you're going to have to move on to something else and just repeat the process that we talked about a little bit earlier. You're going to have to go back to something else and just repeat this process right here. Paper trade, pick out a strategy, understand it, learn where it's a success and a failure, and then repeat backtesting on that specific strategy. And a good way to save time with this, guys, is to backtest it for a month. See if it has positive results for a month. See if the success rate of that strategy is over 50% in 1 month. It shouldn't take that long, maybe a day or 2. And then if it's not, you can move on and do the same thing with another strategy. And once you find one that has, I'd say probably over 50%, maybe 55, 60% at least, then you can move on to fully backtesting it with your, total sample size, not just a month. But you want to find a strategy that works, and you got to make sure it works. I know I've traded a lot of different strategies as a trader. I've traded a ton, a lot of different things. And I'll be honest with you, most of them did not work. Backtesting consists of looking at historical charting and giving yourself and marking down, tallying up how many times it worked versus didn't work. and then analyzing that data. And again, it identifies all these great things about your strategy. You're not really in the dark about the strategy. You know the data. You know where it works, when it works, the stocks it works on, how much it works, and so you can really use that to build a plan and have confidence in that strategy. Like this says, when backtesting, you can use any time frame you like, but the larger the sample size, the more longevity your strategy is ultimately going to have, for the most part. And when I backtest, I can use Thinkorswim on demand to go back in time and really analyze those stocks. I can go back to any date in the last 10 years with most stocks on Thinkorswim and really just analyze that. But that's kind of part of our backtesting class. But the next step in finding consistency, and one of the steps, is backtesting. And so you want to make sure you understand that as well. The next thing we're going over that can really help you target down on that consistency is analyzing range and price and your share sizing. I think this is really important for traders to understand. If you're going to trade a certain amount of stocks, a certain amount of prices in stocks, like if you're going to trade a larger range of prices, you have to analyze that stock's actual range and then use that to compensate for your share sizing, or not to compensate, use that to determine your share sizing. Again, you can't use the same share size you're going to use on a $2 stock on a $50 stock, because what you might lose on a $2 stock is going to be substantially worse most of the time on a $50 stock.
You really have to know where the candles are going to go to. If you don't understand the actual range of the stock, then you're not going to be able to even understand the risk in the stock.
Right. And that's a big thing. That's a big thing that traders need to understand, is that each stock has a different range. Like for instance, even if we'll go over an example in a second, but just looking at this picture, this is BOX here. It had a pretty big range today, and this is the one I traded. The range was a few dollars. But to go into this, to analyze the intraday range of a stock, you mark down the high and low of pre-market or the current day. Most of the time I use the current day, but it depends on how much it's moved in pre-market. But this should give you a good indication of how much that stock is actually moving. It should let you know kind of how much the stock is going to move, potentially. With that in mind, larger range stocks should be traded with smaller share size relative to more expensive or cheaper stocks to compensate, and vice versa. That way, your gains and losses, they're not going to be all over the place. You're not going to have a bunch of small wins but then a big loss, if you understand the range, and thus it's easier to analyze and find that consistency. It's really easy to see what you're doing wrong, because if you might be trading right, except for this, if you have a bunch of green days and then you have one big red day, you might be actually trading right. You just need to scale down a little bit on the bigger range stocks, and this is a mistake that I've done a lot. Again, this kind of reiterates that higher price stocks typically have larger ranges, although that's not always the case. You will find a more expensive stock that moves less than a $2 stock. It all just depends on the day and the range on that particular day. And so, with that in mind, we can go over this actual example here. Okay, so look at the price of this stock. This is roughly an $18 stock. To calculate the range of this, at least the way I do it, is I mark the high of the day up here at about 19 and the low of the day a little bit over 17. That gives me a $1.93 range for that specific day. All right, and this is, like, again, just to confirm, this is an $18 stock. This is BOX from today. Now, if we look at AMD, which is a roughly $21 stock, it actually has a smaller range, and so I could actually use more sizing on AMD compared to BOX, even though BOX is a cheaper stock than AMD. AMD is more expensive, but it has a smaller range. Again, you can look at this, $1.93 range for BOX and an 82-cent range for AMD today. And so this is kind of showing my point, is that just because the stock's more expensive, it doesn't mean it's going to have a larger range. And just because the stock is cheaper doesn't mean it's going to have a smaller range. And like this is what you really got to understand. Like I said, I know a lot of traders, they simply end up trading the same share size relative to the same price of the stock. If the stock is roughly around the same price, even though the range might be 2 or 3 times what the other one was, they're still going to take the same share size. And what's going to happen when they do that? Their wins and losses are going to be all over the place. And they're going to be wondering, man, I had more green days than red, but I'm still down. What happened? What happened was they traded a stock that had a larger range with the same share size. And you want to analyze that and be able to understand that so you can try to make your wins and losses as consistent as possible. It's not just your wins. You want to try to make your losses consistent too. You want to make them not consistent in how often they happen, but consistent in the size of those losses.
Yeah, definitely. I do. I think it's a really good, valid point you're bringing up. How a stock can be in the same price range, but at the same time be completely different because of the range it's trading intraday. A lot of traders use an indicator called ATR. It's the average true range. And so essentially it takes the bottom and the top and kind of takes an average, and it'll tell you a kind of essentially a range. And a lot of traders try to tackle this range when they do their trade. They also use it to determine their risk and reward levels. Because usually you're not going to get more than the range. Even if you get this complete range, you should be getting out of the stock. You shouldn't also be kind of illusional and not holding to those points.
Right.
And kind of expecting more.
Don't be greedy,
Exactly. So use those average true size, or really take a look at the range so that you have an ability to really understand risk. Because if you're not understanding your risk in any one trade, what it can do is it can put you in a hole. And especially if you're a new trader out there, you definitely don't want to fall into any holes, because the moment you fall into a hole is the moment you stop believing in your strategy, in your system, and you start going back to all the old trading mistakes that you used to make and can make again.
Right. 100%. And it's super easy for a new trader to do that. It's really common. And again, you want to make your trading as consistent as possible. Like that is the goal. That should be everybody's goal as a trader, is to make their trading consistent. Even if you have losses, that's okay. But you want to make sure your losses aren't all over the place. That one loss isn't $20 and your other loss is $100. And the same thing for your wins. I mean, wins, it's a little bit more malleable, but you want to make sure that you're making it as consistent as possible. And you do that by analyzing the range of each stock before you get into it. Mitch talked about it the other day, how if you're risking 30 cents on one trade, yet 20 cents on another, you're going to have to scale down in sizing a little bit so that your wins and losses aren't over the place. If you're risking 30 cents on one trade and 15 cents on the other, your 30-cent risk should be half the share size to really target down on that consistency. Like, does that make sense? Like, does everybody understand that? So, like, if you're risking 30 cents on one trade and 15 cents on another, the trade with 30-cent risk should be half the sizing. You should have half the sizing in that trade. So I hope everybody understands that, because that's how you're ultimately going to be consistent with your wins and losses. If not, say you're using 1,000 shares. If you take a 15-cent loss, loss on that, you're going to be down. One loss is going to be 150. One loss is going to be 300. And so you want to make it as consistent as possible, even your losses, because that's about analyzing the risk and then compensating for the larger or smaller risk with your share sizing.
Definitely. This is where a lot of traders go wrong. And we talked about this yesterday. They increase size and kind of limit their risk, bring down risk. They think that increasing size, you just hold to a smaller risk amount. Or in this case, let's say if the range is 30 cents, or if the candle itself, the one candle itself is, let's say, 40 cents, they expect to hold a 10-cent stop on the last candle, and almost every candle that you see this stock moving, it's moving like 40 cents. Yet you want a 10-cent risk. It's
Right.
just not going to happen.
Right. You let the chart determine where your risk is. You don't base it off of how much you're afraid to lose. You base it off of where the chart is telling you is the most reasonable place to put that risk. And then you adjust the share size accordingly. If the chart is telling you your risk is 30 cents, but your reward is 90 cents, then you're going to want to scale down a little bit. Because if that's the one trade you get stopped out on, you're going to be down much more than you usually are, and that's going to hurt your consistency. Once we have that kind of laid out, we could just, just to end this section of the PowerPoint, remember, the more data you take from your own strategies and trading, the better your chances of success. Be honest with yourself, even if it hurts. I know it's something that's really hard to do, is just to be brutally honest with yourself about what's going on. Because that pain is what's ultimately going to drive you to success. You're not going to want to experience that pain anymore. You're not going to want it to hurt anymore. You're going to have to delve into what's actually going on and what you're actually doing wrong. So just be honest with yourself. Be honest with yourself about whether that strategy works, what mistakes you're making, all of it. Go
You
ahead.
know, on that point, I really think it's definitely it's kind of vital to your success. We put so much effort into our trading and into learning how to trade, and then we put even more effort to actually taking the trades. What people forget to put their effort is what I call kind of like the aftermath of the trade. The aftermath of the trade is actually analyzing your trades. If you don't take your data and you don't understand your tendencies, then you'll never be able to actually master your trading mistakes so that you can even get to the consistency that you need. Once you're at the consistency, the road's not over. That's just now the beginning
Right.
of the consistency road. But if you're trying to get to consistency, the first things first, you have to figure out your tendencies. How are you going to figure out your tendencies? It's going to be data, 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 data. And the more you get, the more you'll understand how to better your trading strategy or even better your own mental approach so that you can get your results that you need.
Is understanding how you trade, what mistakes you make, what things you do right, focusing on what you do right, trying to eliminate what you do wrong. That's what you need to do. So, moving on. Now, the next section of the class today is rules in trading. Giving yourself rules to follow and how to identify these rules and create these rules for yourself. All right, so first thing, why do we need rules? Rules are another crucial side of finding consistency as a trader. You can only really know yourself and how you will respond if you are actually using real money in trading. It's just the truth. You're not going to really understand it about yourself using fake money because it's fake money. You may be way more liberal with your trades using fake money. And so that's why people always hate on paper trading, is because it's not real money and you're not actually going to know how you're going to respond unless you're using real money. You don't actually know what you're going to do unless you use real money. Even if you paper trade for a year, everything's going to change when you use real money. That's why a lot of traders are profitable paper trading. But once they take the leap to real money, they start making mistakes that they didn't understand before. All right, and so that's why giving yourself rules is crucial. You'll probably have to use real money before you can really give yourself real rules to follow that are personalized for you. Again, one of the ways to combat this and using real money is just to take it slow at first, using small sizing to protect your account. Trust me, the first time you use real money, even if it's small sizing, you're going to understand yourself a little bit better. You're going to understand what you possibly might be doing wrong a little bit better, even if the sizing is small. And so use real money. You can figure out your rules, but take it slow. Use small sizing. You don't need to go huge at first. Just take it slow. Try to figure out who you are as a trader, because you're really not going to know until you start using real money. And that's the brutal truth that nobody really talks about.
Yeah, definitely. I mean, this is where if I could go back as a trader, I would probably make the most changes. Is I would love to kind of go back and instead of using those accounts that I kind of call the pain accounts, because at the end of the day, a lot of us have to go through the pain of making the errors in trading so that we really start taking ourselves serious and holding ourselves to a process. And what I would rather do is I would rather much take that with smaller sizing, even something like trading on TEFs with as small as 50 shares, 25 shares. You could really learn from trading in that sense, or even one share. I've learned that actually, one share can be beneficial to the kind of mental process of actually taking a trade. Just because in the end of the day, if you do take any trade, you're gonna have to pay a commission, and just that alone puts the pressure on you, and it can create some of the emotions you're gonna feel when going live.
Right. It's like a shock collar.
Yeah, exactly. You want to at least feel a little bit because
Right.
you're going to feel it. That's without a doubt. I don't think there is any human being that can trade without feeling any sense of at least some emotion.
Right.
You know, and so the real key is learning to control it. How you're going to control it is first realize that it's not about gaining the money. That needs to be the furthest thing from your kind of goal. The first thing needs to be is learning how to really become a good trader. And that's what we're really trying to teach you is that you have to get over certain things in trading so that you can focus on what really matters.
All right. So the few steps in giving yourself rules to trade. The first thing you really want to do is you trade for a week with real money using the research and tested strategy we talked about earlier. You need to use real money because, again, you're not really going to understand yourself until you use real money. You might think you do, but as soon as you hit that buy button with real money or that short button or whatever, you're going to get that rush of emotions. Whether it be happy, sad, scared, nervous, whatever, you're going to get that rush of emotions. And so you're going to want to trade for a week at least using real money and to really see how you're going to respond to the market when you have skin in the game. You got to have some type of skin in the game, and this is going to show you how you respond to it. So once you trade for a week, you want to identify the mistakes you made and target down on what really went wrong. Whether it be over trading, not trading enough, exiting too soon, holding it past your levels, whatever the mistakes you make are, you want to be brutally honest with yourself about those mistakes. You can't hide from them. They're actually a good thing in this regard because you're actually going to understand what you need to fix, what you need to set rules for yourself with, what you need to do to change. And so, again, it's super crucial to be brutally honest with yourself about the mistakes you made during this kind of learning experience for yourself. Um, so,
Yeah, one of the real keys quotes that I used to use before kind of that I didn't need to know anything in the market is one of the real keys that I think kind of got me on the process was a quote that I'm willing to take the responsibility that I'm willing to do whatever it takes to get me to where I need to go. So that's really realizing that at the end of the day, you can kind of hide from your bad trading mistakes and kind of be happy about your good trading mistakes. But it's until you take that responsibility in your trading, kind of like if your trading was just out there to everybody and you couldn't hide anything, take that responsibility in your trading, and then you'll start taking the process down.
for sure. And it's one of those things where you got to be responsible for how you trade. And like I said, it's kind of a good thing because you're going to know what to fix. But if you're not honest with yourself, if you let your ego get in the way and you say, no, I'm a good trader, this was the market's fault, or this wasn't my fault, this was the platform, or whatever you want to blame it on, you're never going to evolve. So you want to be honest with yourself, see what went wrong, see what you did, and then fix it. All right. And so once you do all that, the next obvious self-evident step is give yourself rules to combat those mistakes. If you're over trading, do like I do. Set yourself a trading limit. If you're not trading enough, set yourself a trading minimum. If you're exiting too soon, give yourself a specific point on that chart that you have to hold it to. If you're holding it past your levels, give yourself a rule that says you have to exit at a specific point a little bit earlier. Give yourself rules to combat those initial mistakes. And this is important. Be honest with yourself. Understand what you did wrong. Really research it. Analyze what you did wrong. And then build rules around those mistakes. All right. And then after you do all of that, you're going to want to trade for another week actually following those new rules you've given yourself. I think this step's super important as well. It's not done after that first week. You want to see how your trading reacts to those rules. And it kind of goes back to conditioning. If you do something over and over and over and over again, your brain's going to be more inclined to do it again. And it's going to get easier and easier to follow those rules. And so it's kind of conditioning. Just rinse and repeat. Follow those rules. Identify the mistakes you made in that week as well. See if you made any new mistakes that you weren't making the previous weeks. Give yourself new rules to follow with those. And then after you've done this enough, you can really tweak those rules if necessary. I think this is what a lot of new traders skip. I think a lot of traders skip many of these, but this one in particular, is that they don't analyze their losing trades. They get bummed out. They don't like looking at their losses. It hurts to look at them, and so they just ignore them, act like they never happened. Try to come back to the market the next day without changing anything. You're never going to be successful doing that. You have to identify what is going wrong in your trading and then work on solving it. It hurts to look at, but again, it's actually a good thing because you're actually going to be able to fix what went wrong and work on fixing what went wrong. And so I think those are super important as well. And again, don't slack on this stuff. Giving yourself these rules is super important. And so we could just review the rules I've given myself as a trader as an example. One of my things was over trading. I would force too many trades. And so my rule to combat that was I only traded 1 to 3 trades max per day. I can't trade over 3 times a day. I just know myself too well. I know I'm going to force trades if I allow myself to trade more than that. Another one is that if I have 2 losses in a row, I am done trading for the day. I cannot trade anymore. I cannot allow myself to trade anymore. Because again, I hope you guys can see this, is that this is building consistency. I have a set amount of trades, a maximum amount of trades I can do a day. If I take 2 losses in a row, I'm not going to let any more losses affect my consistency, and so I have to just be done. We researched my trades a few weeks ago, and one of my mistakes, even though it was a green week, I had a profitable week, but one of the mistakes from that week was that I was entering fades a little bit too early. And I was hurting my risk and reward in doing so. And sometimes it would be a profitable trade, but my risk and reward was messed up from it. And that's going to hurt my consistency. And so that's another rule, is that if I'm entering a fade, it has to be around or above the VWAP at least. If it's way under it, I can't trade it. Another rule for myself that I think all traders should follow is that calculate risk and reward in your plan in each trade you get into. It kind of goes back to the first slide. Don't just trade it because it looks good. Trade it because it follows your parameters, it fits within your risk and reward plan, it fits within your trading plan, and then trade it. If it doesn't fit, ignore it. Move on. FOMO is one of the hardest things to combat. People get bummed out if they're missing stuff. Don't sweat it. Understand that if you stick to your plan, if you stick to your risk and reward levels, that you're going to find consistency as long as it's a viable strategy and you're actually holding it to those levels. Another rule is that I only trade the first 2 hours of each day. Eric talks about it all the time, that lunchtime chop can really hurt your trading. And for me, it really can too. Even afternoon trading, I'm not that great in. I don't trade very well in the afternoon. And I know that about myself as well. And I learned that about myself when I analyzed all my trades and understood that a lot of my losses came from the afternoon session. I just didn't perform that well. And maybe my strategies don't work that well in the afternoon. And so because of that, unless I'm going to trade different strategies that I research myself, I'm just not going to trade after the first 2 hours of each day. It's just not something I'm interested in doing. And then the last one, I don't trade stocks over $75. They're just too expensive for me. I'm not saying you shouldn't. I know Francis likes trading Apple and some other ones, and that's fine. If it works for you, it works. I can't hate on anything that works. If it works, more power to you. And so then final thoughts on this PowerPoint, and I think these are really important to understand about all of these, and I might have touched on some of these already, but final thoughts on finding consistency. 1. If your risk is constantly changing in each trade, you're not targeting a specific enough range in your stocks. If your range is going from $1 to 10 cents, you're not targeting a specific enough range in your stocks and pricing of your stocks, and so you want to understand that. Number 2, like we said earlier, avoid big drawdowns in your account by sticking with consistent share size, range, and pricing. Like we said earlier, if the risk on your stock on your trade is 30 cents and the trade before it was 15 cents, size down a little bit. Compensate for that larger risk. That's how you're going to find consistency. Don't trade it because it quote unquote looks good. Trade it because it fits within your plan, strategy, and risk reward targets. Super important. We've touched on it before. A lot of traders just kind of blindly jump in a setup because it looks good and they're kind of antsy and ready to trade. They can't not trade. They feel like they have to trade and it looks good for them, so they're just jumping in. That's gambling. Might as well go play slots at a casino or play blackjack or something, because you're never going to find consistency with that. You got to build an organized plan to follow. One of the more important things is that it's a process. Don't rush it. Take it slow. Once you're a successful trader, you'll have a lot of time to enjoy it. But as a new trader, don't rush it. Take it slow. Take it slow with sizing. Take it slow with everything, because slow and steady wins. And if you rush into it, you're bound to fail. Last thing, be objective with your data. Super important. Be honest with yourself. Be honest with yourself about everything. About whether your strategy works, whether your mistakes are there or not. All of it. Be objective. Be as objective as you can. You're never going to have perfect objectivity as a trader. You're always going to be a little bit biased towards something. You're going to think you may be a little bit better than you are. Maybe you're a little bit worse than you are. Maybe your mistakes aren't that bad. But your goal is to be as objective as you can. You're never going to be perfect, but you got to be honest with yourself.